Hi everyone, welcome to the Ticker TV. Payal from Ticker News this side. So today we have our special guest Kanika Pasricha, Economist with Standard Chartered Bank, joining us live today to share her views on bonds and rupee in the upcoming fiscal year. Hi Kanika, nice to have you at the show. So now on the government bonds front, we have seen significant hardening in the bond yields. So how do you expect the bond yields to trade in the upcoming fiscal year, and what all factors do you think will impact the market in FY19?
So we're expecting the 10-year bond yield to stay at elevated levels. Like today it's at 765, remain close to 750 till June. Because there are few factors which are weighing on the bond market sentiment. The first factor is unfavorable supply-demand dynamics. What we have seen recently is that while year-end we actually see lower supply, leading to some cool off in yields, which is like a seasonal pattern. This year it's not played out because the demand from nationalized banks has been limited, and also the RBI has not given indications of the hike in FPI debt limits. The second factor is that globally the yields are actually witnessing upward pressure, especially in the US. We've actually seen the US 10-year rise more than 40-50 basis points since the start of 2018, because there's been a repricing of Fed rate hikes expectations, especially post the approval of the tax reform plan in the US, which is going to completely change the economic outlook for the economy. However, we believe that there is still expectation, there's still hope of correction in yields on account of the basic factor that valuations in IGBs remain attractive. The 10-year repo rate spread of more than 150 basis points is unlikely to sustain, first. Second, we expect the MPC, the Monetary Policy Committee, to maintain a prolonged pause on rates because growth concerns continue to remain. This year, India has been a unique story. While globally growth is picking up, in India growth is expected to hit a 4-year low of close to 6.5%, because policy reforms have led to disruptions in the short term, and that pain is likely to persist further. Third, private capex recovery still continues to elude us, and also given that growth remains muted, the Monetary Policy Committee, in our view, will be favorably surprised on its inflation projection of 5.1% in Q4 FY18 and close to 4.5% excluding the impact of house rent allowance in FY19. So all these factors combined, we believe that after staying close to 7.5% levels till June, there is a scope for correction in yields, downward correction to close to 7.25 by December, and also staying close to those levels till March 2019.
Okay, now moving to the currency front, that owing to the weakening in the greenback, we have seen rupee has appreciated so far 7% in 2017. So how do you see it in FY19, and what all factors are likely to impact the currency?
So INR, we believe that INR, notwithstanding the recent depreciation that we have seen in the rupee, especially because of repricing of Fed rate hikes and its implications for the US dollar, we've seen rupee move to close to 64.60 levels currently. After the recent depreciation, on a fundamental basis, in our view, there's a scope for appreciation in the rupee. We're expecting rupee to hit close to 60 to 50 levels by the middle of the year and move closer to 61.50 levels by end 2018. Now, what's the reason? There are two drivers. First is that USD INR is a pair, and on dollar, our core research view is of broad dollar weakness. What's the reason? We believe that in US, agreed that there's repricing of Fed rate hikes, and in the short term, it's buoying the dollar. However, if you see fundamentally, pickup in growth in US is going to lead to worsening of the twin deficit problem of both fiscal and current account deficit in the economy. In the fiscal deficit will hit close to 4% of GDP in our view this year, and current account deficit will move closer to the 3% mark. And also, more importantly, when global economy is recovering, risk assets are bound to do well, and the demand for safe haven dollar will suffer. So which is why we are holding on to our broad dollar weakness view. The second factor which in our view will buoy the rupee, will support the rupee appreciation, would be the fact that while rise in commodity prices is leading to deterioration in external sector balances in India, the deterioration will be lower or much less compared to what's happening in the US. In India, we're expecting current account deficit to move to close to triple. This year it will be 1.7% of GDP in our view. There's a risk to this view. It may be slightly higher. And next year move towards there will be marginal deterioration further to 1.8% of GDP. Cannot deny the recent trade numbers do lead to upward bias to our current account deficit forecast, but still the deficit will remain lower compared to what we are expecting in the US. So the relative story will play out first, and the broad dollar weakness view is giving us confidence that there is scope for rupee appreciation in the coming quarters.
Okay, now our last question on the interest rate front. What are your expectations from RBI and FOMC this year? How many rate hikes are you expecting from the FOMC? They have projected a dot plot of 3 for 2018 and 2 for 2019. So what are your expectations on this?
So, as I stated, that the US tax reform plan has actually completely changed the economic outlook in the world's largest economy. We're expecting growth to pick up, inflation pressures which were not yet seen emerging in the economy last week when we got the US CPI data. There has been an uptick in price pressures in the economy as well, and we expect the momentum to continue. So we believe that for the US Fed, the comfort level for inflation is 2% on the core PCE, and that comfort level will be achieved in 2018 itself, which is why in our view there's scope for 4 more rate hikes in 2018, followed by 2 more next year, taking the US terminal Fed funds rate closer to 3% mark. So the core view remains that there's scope for persistence of monetary tightening cycle in the US economy. Now, what are we expecting from the RBI? See, incidentally, we believe that RBI may be an outlier in the current situation, and we're expecting a prolonged pause on rates. What is the reason? Because Indian economy this year is also an outlier in terms of the growth and inflation dynamics being witnessed. Growth in FY18 is expected to hit a 4-year low. In fact, it will provide a downward surprise in our view to the MPC even in FY19, because the MPC is expecting growth to recover quickly on the GVA metric to 7.2%, while we believe that the recovery will be gradual to 6.9%. And second, on inflation, as I stated earlier, the MPC is expecting inflation to move towards excluding the impact of house rent allowance, to remain close to 4.5% levels in FY19. In our view, after excluding the impact of house rent allowance, inflation will be lower at 4.25%. So given this kind of view that we have, and plus that growth will continue to remain on a gradual recovery path, there is only a case of growth concerns remaining persistent, especially in terms of a credible recovery, because private capex is unlikely to be a story of FY19. It will be a story of FY20 after the general elections related uncertainty is taken out. So in this kind of a scenario, we believe that RBI is likely to maintain a prolonged pause on rates unless there are 3 factors. One is that oil prices rise significantly. It should be noted that in our forecast, we have taken an uptick in oil prices to close to $65 per barrel in FY19, the average, compared to close to $55 to $57 per barrel in FY18. Second would be the announcement of minimum support price hikes for food prices in the budget. If the hikes are steep, very steep compared to our expectations, we believe that the upside impact on inflation can be 15 basis points. So if it's steeper than even these expectations, scope for rate tightening increases. And third is if growth picks up significantly more than our expectations. The pickup in growth momentum is higher than what the MPC is also looking at, which is 7.2% on the GVA metric in FY19. So broadly, unless the risks pan out, in our view, the core view is of a prolonged pause on policy rates.
Thank you, Kanika. It was nice talking to you.